Good day all. Today I would like to discuss our global equities view. As economic indicators start to roll over, the market is questioning US exceptionalism, with the leadership of technology or AI stocks being challenged in an environment of uncertainty and high starting valuations. Technical indicators of the Nasdaq and the S&P 500 have turned neutral for the first time in a year, while earnings estimates for 2025 are still forecasting to grow at 10% year on year. This will be led by AI tech, financials, and industrials. However, margin pressures persist in the discretionary sectors due to wage inflation and rising costs. The stability in the labour market has provided support for domestic demand, but we must watch consumption patterns for the lower to middle class households, as this could limit consumption in the latter half of 2025, and we could see inflationary pressures re-emerge. The S&P 500 trades at a forward PE of 21.5 times, which is well above the 30-year average of 16.9 times, indicating limited room for upside in aggregate unless earnings accelerate significantly. The top 10 stocks in the S&P 500 account for over 38% of the market cap and reflect high concentration risk. Despite this, broader participation in earnings growth is emerging. In the Eurozone, GDP growth remains subdued at 1.2%, constrained by weak industrial production, particularly in Germany, and persistent inflation. Corporate earnings are forecast to only grow at 3.2% year on year in 2025, with healthcare and utilities leading defensive sectors, while industrials and materials struggle with input cost pressures. The recent German elections, combined with a push to collaborate defensively across Europe, has provided a catalyst for fiscal stimulus, which has led to a resurgence of Europe's medium-term economic prospects. Eurozone equities traded a forward PE of 13.9 times, which is in line with historic averages and offers a relative discount to global equities. US equities are providing attractive valuation opportunities with high dividend yields and depressed valuations, especially in the energy and financial sectors. Fund flows into Europe equity funds turned positive late in 2024, reflecting improving investor sentiment, but at a much slower pace. Although shorter-term performance has improved, medium and long-term momentum at a relative and absolute level for European equities remains very weak. Looking now east, Japan, GDP growth is forecast at 1.3%, supported by improving corporate governance and robust export activity amid yen weakness. Earnings growth of 8% in 2025 is expected, led by technology and automotive sectors. While domestic consumption remains stable due to government stimulus, the impact of reshoring trends in the semiconductor and high-tech supply chains could provide additional upside for Japanese manufacturers. Japan trades at a forward PE of 14.7 times, significantly below the US and global markets, with attractive dividend yields and share buybacks supporting valuations. Export-heavy sectors like technology and autos remain undervalued relative to global peers, while technical support levels indicate strong buying interest from both domestic and international investors, particularly in the export-driven sectors. Despite the consolidation in the market for most of 2024, in absolute terms, Japan looks attractive across most periods and technically has reached levels where we can see a potential bounce. Emerging market GDP growth of 4.1% is being driven by strength in Asia, particularly India and Southeast Asia, who are benefiting from the AI investments and supply chain realignments. Earnings growth is projected at 18% for 2025, led by technology and consumer sectors in Asia, while Latin America remains challenged by commodity volatility. Emerging market equities traded a forward PE of 12 times, significantly below developed markets. US 21.5, Europe 13.9, as I said, offering attractive long-term entry points. Regional valuation disparities provide opportunities, with India and Taiwan trading at premiums, while countries like Brazil, Mexico, and the UAE remain undervalued. EM and Asia are weak in the short term, while Asia is on a medium-term and longer-term basis on the verge of breaking lower. Flow data would suggest a sharp turnaround in positive flows towards China can be expected. Looking forward, the Trump presidency 2.0 is creating uncertainty and volatility for the global economy and markets. And we feel that the following three key themes will dominate the investment outlook. Number one, a return to supply-side policies in the US. 2, an increased acceptance of fiscal loosening. And 3, an escalating battle between globalization and protectionism. The macro backdrop remains supportive for equities, but some caution is required in the near term as the US exceptionalism is under threat, with Europe and China embarking on fiscal expansion. This could lead to a market leadership change. Given this backdrop, gold should continue to perform strongly, and we could see commodities pick up if China stimulates aggressively. These core investment themes remain compelling, but as noted, they are evolving, and we are following a barbell strategy of investing in mega cap in the US together with select value, cyclical, and smaller cap stocks globally. We will continue to monitor global and local political developments and inflation trends to guide our investment strategy, ensuring alignment with our long-term outlook. Thank you, and until next time, goodbye.